The dollar seems to be on the ropes, having erased its gains for 2020 versus a basket of currencies. The reversal stems from the Federal Reserve's apparent resolve to keep printing money at the current pace despite signs of an economic and inflationary rebound. That begs the question then, is the rise in consumer price inflation transitory or not? And to help answer that for us, we bring in Zacks chief equity strategist and economist, John Blank. John, what is the current inflation risk?
Well, Terry, let's look at some calculations on the consumer price index, leaving the CPI at 100 in 2018. And we are actually middle of 2021. So I'm talking 1, 2, 3.5 years of time. So over 3.5 years of time, you would expect at the top end at a 2.5% inflation rate to be at 110 with a Fed that's very complacent with inflation. So a 110 index number. If you have a pre-pandemic Fed that's not as complacent and not as willing, you might go 2% a year, about 2 to 2.5. That might take you to 108. So the latest CPI, which is not ex food and energy, by the way, which just is the broad CPI, is about 107. So the point is, much like earnings for the United States and the S&P 500, all we're really doing is returning to trend and rapidly approaching that pre-pandemic Fed level. Now, if you take the ex-CPI, ex-food and energy number, I'm at a 105, which is actually only 5% over 3.5 years, which is way below the 2% number. So the other point to understand here is you take away food and energy out of this equation, we are actually way low on this inflation risk, and that drives it. What's really going on is there's been some rotation in a lot of COVID-related things like housing, asset price rises, used car prices, and things that are related to COVID exit that's driving up this thing, including a lot of food prices and energy. Obviously, I'm looking at $4.25 for a gallon of gas out here in California. So these are the real issues. None of this, by the way, reaches that post-pandemic Fed, which we're still way below. So point is, the risk of inflation is overstated, and the 10-year rate, which is, by the way, down below 1.6 at this point, is telling you that basically, no, the pre-pandemic Fed is not even going to be approached. The core ex-food and energy CPI is still fairly low, and really what we're looking at is aggressive rotations in demand and some supply response that's coming out of the COVID pandemic, and that's what we're really studying.
Then do you think the Fed is measuring the inflation risk correctly, especially as it correlates with interest rate risk?
Yes, I do think they are measuring it correctly, and I think people have understated their awareness of asset price bubbles, and they are likely to taper on the housing risk for that reason. But I don't think they're wrong about inflation, and I do think people are understating their ability and willingness to understand asset bubbles, and then they put that into their discussion.
This week, several sets of U.S. macroeconomic data came out revealing the health of our economy. What actually did it reveal?
Well, Terry, what it revealed is what happens when you send 9 stimulus checks to consumers. The last one was in March, and now they're petering out in April. So we're going to actually get some negative income numbers, and that's really a relation to the idea that we're no longer sending checks to people. And this is really the question now remains is whether the 22 to 24 states that pulled unemployment benefits made a good decision or a bad one. And we're going to see what happens here on that.
And which economic sectors do you see holding up well going into the second half here?
To be honest, Harry, I think you got to like tech. You've got to like some of the industrial and cyclical names, and you probably got to like some of the cyclical names in like chemicals and things like that. I probably would stay away from metals prices, though. I think that's been overdone.
Auto's going to cast a shadow on things?
Autos are probably overdone, too, yeah. I would think a lot of people are going to wait for better electric vehicles in the next couple of years, so it might stall, just keep it an internal combustion engine for longer than people think.
Do you see a Fed policy change on the horizon at all?
I do. I think, as we've talked already about the tapering, for the housing bubble. They are aware of this bubble. They are talking about this, and it will begin probably in the fall into the winter to be a real discussion that hits the FOMC minutes. And when it does, then people will really take it seriously.
You mentioned stimulus checks. How close are we to a full economic recovery here and a return to organic economic growth versus growth by stimulus?
That's a really interesting question, Terry. The Australian economy is not going to open until the middle of summer 2022, which is probably when I think we'll get a full bite on the ex-COVID realization. I think the next year basically is be sloppier than people think.
What's your take on other global economies right now?
Well, European economies are certainly one of the places to look for the next level of vaccinations to improve and to see some stimulus there. But the problem there is they generally are not very strong growth economies, nor is Japan. Obviously, Japan done a terrible job with their vaccinations. They had this pandemic. They've had all this experience. They have a fairly tight-knit situation, and they had the Olympics, and they didn't vaccinate. It's just a mystery why the Japanese are as slow as they are. They're even worse than the Europeans, and it's kind of a mystery, but it's the thing that really, like I said earlier, we got to get these other economies vaccinated, and that's the next stage for growth in the S&P 500 earnings.
We have to bring Bitcoin into the conversation just a little bit. Is the recent Bitcoin developments having any negative economic impact?
Well, it's certainly taking the NASDAQ story down a notch, but it's been rage trading and staggering around for some time anyways. The non-profitable tech stocks and in the ARK investments scenario, I think, are going down with Bitcoin, but I think the other ones will be fine.
Let's take a look at a few stocks you're currently looking at: Wells Fargo, Vail, and Daimler.
Yeah, let's talk these names. Wells Fargo is the number one ranked stock. Obviously, the company's had major problems for years. Big sell-off down in the 20s. Now it's back to 46. Easy to get this stock to 55 or 60 from here at its 46 level. So I think, it's a solid play. You still got a decent 40 cent a share dividend, which will probably go up now they're past the stress test. So you also got a chance to buy, for a longer-term investor, a dividend that probably will go up. Vale, down in Brazil, $22 a share, really richly overpriced. It's $4, $5 in earnings next year. Obviously, that's a really low PE generally, but for these cyclical iron ore stocks, you got to look at them on their own. And this play is probably over. Even though it's a number 2 ranked stock, I'd be selling my Vale, not buying it. And Daimler is way up to $90 a share, which is near its highs, 2018 highs. Target prices are 108. Value score is still an A, is 7 PE. Daimler gets interesting when you consider its ability to electrify the Mercedes lines and get ahead of Tesla here. Obviously, the market's just on a trend bullish case, hasn't broken that trend. I'd be interested in Daimler on a pullback, and frankly, 94 is not enough of a pullback for me. I look for something in the 80s.
Look at the economic picture from our chief equity strategist and economist, John Blank. With John, I'm Terry Ruffalo. Here's a question for you. Why are insiders buying company stock with their own cash? There can only be one reason. They expect a price jump. Zacks is currently revealing the best of those buys until midnight, May 30th. Find out more at zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.